2, 1.
Hello, everybody. Welcome back to the Dash Trader Newsroom. This is the end of summer back to school stock watch. And thank you, as always, for joining us here on this Friday afternoon. And my name is Michael DeJoy. I'm Director of Educational Services and licensed professional here at Dash Trader. And I'm joined by my co-host, Jill Molandrino, Global Markets Reporter from NASDAQ. How are you, Jill?
Good, doing well. Thank you.
That's it. We're getting through summer here. Summer's moving fast.
It is.
It's scary that within 4 months, I mean, it'll be, 2022. I mean, I just can't believe how time is flying by, right?
I just had this conversation with a strategist that was on my show yesterday. I'm like, by the way, what's your 4.5 month outlook for the remainder of the year? And it just sounded funny to say that.
I feel like the year just started and it's just blowing by. I mean, it's crazy. Needless to say, we just had the Fed minutes that confirmed that they'll be ending buyback programs soon. Now, the question is how soon is soon? I mean, we've had quantitative easing infinity for some time where they've just been buying, massive amounts of debt back and with want and abandon. And that has been very beneficial to the markets. What will that do to the market? I mean, we saw an immediate sell-off on that news. And then in the last day, 2 days, we've kind of snapped back as we usually do. The buy the dip crowd came back in and bought the dip. So what are your thoughts on the Fed buyback programs and the long-term effects on the market?
I think there's a distinction here. Tapering is very different than tightening, and the Fed is not suggesting tightening whatsoever. I also think that the Fed has been incredibly telegraphed with their messaging and what they plan on doing. I know October, November is the time frame. And if we get a taper tantrum, consensus has been that it'll be short-lived, perhaps 5 to 10%. But if we've seen all that buying come back in. If the market can't handle tapering, which again is not tightening, those are two very different things. There's a problem there. This isn't a surprise. It could even be where it could be a sell the news kind of event, and perhaps you might see some buying on it because that level of uncertainty is removed from when is the Fed going to taper.
It's finally happening, yeah.
Right, that could potentially be it. This isn't any news. I can't. Unless you've not traded a single stock in your life, there's no one out there in this universe that does not know the Fed is telegraphing tapering. This shouldn't come as a surprise to anyone.
I mean, they've done it for the last 3 meetings that we're going to be doing something soon, and they just don't exactly start doing it. And then, it kind of got delayed by a few months with the advent of the Delta variant and some continued uncertainty.
So that's really what the outlier is going to be, because you have to remember the Fed is looking at employment. In addition to inflation, employment is a key metric that they look at. Stimulus checks will be running out, so it's going to be interesting to see how employment trends pay out. Of course, as you were saying before, Mike, with the Delta variant, the issue really is here with the market is supply constraints, the amount of demand that's up there, and how the underlying cost for everything is just skyrocketing.
Yeah.
I read an interesting report about the cost for going back to college, and this is getting small TVs for your dorm room, your bedding, your towels for your dorm room. It's increased by 10 to 15% year over year just for that. So that's really what the outliers are. And another concern is too that the cost of food is becoming a national issue as well. Many people live paycheck to paycheck, and the fact of the matter is 10 to 15% increases is concerning. So I think that's really there's a lot of variables that are out there that the Fed bases their data on.
Yeah. I mean, the Fed always based their data on inflationary concerns. And the last, couple of meetings, they were talking about inflation being transitory, meaning short-lived. And so far, you have a couple of meetings saying short-lived inflation. That's not so short after a while. And it doesn't seem to be coming to an end. It's continuing. Back to school certainly is more expensive this year than it was in past years. And, I mean, there are so many places where the employment crisis is obvious, meaning people that might be alleviated in the next couple of months because the emergency unemployment benefits are coming to an end this month. And that might alleviate some of the employment issues that some of the employers are having. But I do know that I was at Dunkin' Donuts today and there was literally 2 people there. And I walked in the front door. I could have walked in, picked out whatever donut I wanted and left because there was nobody in Dunkin' Donuts. I mean, they had 2 people working the entire place. So the employment issue is real. And the one kid was 17 years old and it was his first day.
It is real. And, it's interesting. If you're a teenager now, this is probably the best opportunity you'll ever have over the summer to work, just because people are desperate and they're paying well, they're paying incentives. I'm curious to see what it's going to look like when you have this rush of supply back into the labor market, to see how employers manage that. The other thing you have to think of too, with this push for rising wages, which is not transitory, you're not going to give someone a raise and then take it away. Those costs are going to get passed down to the consumer as well, because wages are a massive fixed cost, especially for small businesses. So I don't think it's as transitory as they may think it is, because the costs have to get passed down to somewhere. It's always going to be to the consumer.
I don't think it's transitory at all, because I mean and look, I see prices being I see producers being very they've hesitated to raise prices. So when they finally went and raised prices, they raised them kind of like 2 notches up. So they're not going to notch them back quickly, because they're worried that if it continues, they may have to increase prices again. So I do think that that some of the costs are going to be baked in for at least a year or two, because things don't move quick. I mean, I know that things that you used to be able to order in 2 and 3 days are coming in 12 weeks. Furniture is taking 22 weeks. I mean, a new kitchen.
Oh, I know.
Yeah, I'm sure you just bought a house. So I mean,
I ordered my furniture in April, and I have rugs and artwork and no furniture.
No furniture. So I mean, and like things like windows and doors are like 22, 23 weeks out. Things that are like building supply. So I mean, the supply chain is really, really backed up. And we actually saw that in Lowe's, LOW. I mean, they had like phenomenal earnings. Home Depot also had really good earnings. I mean, they're selling the product. The product is just really far on back order. So,
but Mike, think about what we saw with the housing data that came out this week on Tuesday and Wednesday. We're starting to see less mortgage apps. We're starting to see lower new home starts, because the price of material, the supply shortages, to your point, and because housing has gone up exponentially with demand, there's a lot of people who just simply got priced out of the market. I can tell you where I live, it's a custom home development. So only build like 3-4 homes at a time, or on a street, whatever. And they're building one. They have been building one since we moved in, and the wood was up, the shell of the house. They just started putting on siding, and this is 4 months later, because they couldn't get material.
That's it. I mean,
that's something that should be done. Like, you should be done with a house about 6 to 9 months of that size.
This is like a trifecta of inflation and supply issues, as well as, I mean, there's just also just weakness in the dollar, right? So, I mean, you print so much money. I mean, it's $11 trillion of stimulus, and, that weakened the dollar. So it's causing, inflationary concerns just from dollar weakness. And materials like aluminum, these things are all, they're all purchased in dollars, right? So if the dollar gets weaker, the price of that goes up in dollars. So, I mean, we're really getting a trifecta of problems that has caused inflation. And of course, that means the Fed has to end these buyback programs. But they have been well telegraphed. And certainly, I think the market is prepared for whatever is going to happen. So that brings us to what it's caused overall in the market, which is volatility. August is traditionally, I mean, I've mentioned this a number of times, that statistically, the 3-month period of the year for increased volatility usually starts in August, September, October, and then it starts the bullish 3-month time of the year, which is, December, January, November, December, January, kind of like that Santa Claus rally time. So usually, I mean, the market comes down, and then it rallies up going into the Santa Claus rally. But August and September and October tend to be, September is the month statistically that most market crashes occur. Not to say that the market is going to crash, but certainly it's statistically a very, very bearish month, and we've had an incredibly bullish year overall. So we've had a little bit of volatility come in this August, and I don't know whether that's because of the Delta variant, whether it's Afghanistan. I mean, now we have the ongoing Afghanistan issue. And then, of course, we have the rush back to school where parents are in the Northeast. In the South, kids are already back in school, but in the Northeast and in the North, you tend to go back to school in early September. Whereas in the South, they tend to start going back to school in mid August into end of August. So I'm not sure what which one of these myriad of factors caused the volatility. But certainly it seems like volatility is back in the market. So what are your thoughts on volatility overall and kind of the cause of the roller coaster that we've seen a little bit as of late?
Yeah, it's interesting. While it feels like the market is a little bit more volatile, it's actually has come in a bit somewhat here. I think what's even more interesting is the pattern of trade that we've been seeing, where we come into, the futures in the morning are showing the major averages down, and then they just slowly creep up after the European close. I feel like this happens like 2-3 times a year where that pattern emerges for a couple of weeks. And the markets are always worried about something. And it's really hard to pinpoint what it might be attributed to, since we have a lot of variables out there. I thought that the way the market digested geopolitics this week was interesting and a bit unexpected. I would have thought we'd see some sort of a sell-off or more volatility than we saw. I think really what the outlier is going to be, and if we had to pick a sector that could be impacted the most, would probably be retail. And we've heard about it in the guidance that we've gotten this week when we had the major retailers come out. Their quarters were fantastic, record-breaking the 2019 numbers before we had COVID. I think their concern is with the Delta variant and any other variants that emerge, we might not go into lockdowns per se, but that doesn't mean consumer behavior won't revert or people make the conscious decision to dial back a bit on in-store shopping, which is such curious timing because brick and mortar had a great quarter. Amazon announced, I think it was Wednesday when Macy's, or yesterday, whenever Macy's reported that morning, or the day after, whatever it was, that it was going to open brick and mortar locations. So obviously it's not a decision that they made that morning, but something that they've been analyzing over the past couple of quarters. And with the strength of the consumer and people going back into stores, I mean, up until the past couple of weeks, everything was, packed the way it used to be. So I really think the outlier is going to be in the retail space.
Yep, absolutely.
Hopefully
I do think that I think that part of the retail comeback was pent up demand. Like people wanted to get out. They were going to stores. They were buying all the things that you want. I mean, certain things like sneakers you can buy online, but clothes you want to go to the store, try them on, maybe check them out, quality of different things, see furniture. You might want to see your furniture and sit on the couch, right? I mean, you might want to, lay down on the mattress and try out the mattress if you're going to be sleeping on it. So those kind of products, I think, really benefited from the, people wanting to get out of their house and go check out these items themselves. And then, of course, now with this, with concern about additional variants, retail, has a little bit of this dark cloud cover again. That maybe not lockdowns, but maybe people will just choose to stay home. And certainly that is hanging over the sector. So let's talk about some safe stocks to watch out. To watch if the volatility continues. Steady returns and dividends, maybe they may be the order of the day. So I mean, just thinking ahead, one of the stocks that I came up with, and I'll be talking about the chart when I look at the charts later on today, is like McDonald's. It's been steadily inclining, increasing in price. It has a dividend. It seems to be kind of a traditional consumer product. It never seemed to be, it never really was affected. People were still ordering McDonald's in the midst of the pandemic. Certainly that was one of them. But, these kind of consumer staples and or old economy stocks seem to be more resilient in inflationary times. Inflation tends to affect tech companies that are really, really reliant on low interest rates. So what are your thoughts on some areas of safety if the volatility continues?
I think areas of safety with the volatility continuing, and I would say even without volatility, I think anywhere within the tech space that is SaaS focused, because a lot of the trends that we saw emerge are not going away simply because COVID is over or we're going back into the office. I wouldn't call it work from home. I wouldn't call it return to office. I wouldn't be that deterministic about it, but I would say that the work from anywhere environment is not going anywhere because as far as we know, for the time being, nobody is going back to the office 5 days a week or wants to go back 5 days a week unless they are in an operational or a mission critical tech position. But for those of us that are, in marketing or communications or in sales that have the ability to work remotely, workers want that hybrid environment. You want better quality of life. They don't want the commute. They want, they have kids they have to deal with, or school, whatever the case may be. So work from anywhere is not going anywhere. I also think when it comes to conferences, let's say in a year or two from now, we're able to have in-person conferences like we used to. I think we're always going to have a virtual element because not only is it more cost effective for people, for companies sending their people there, it also democratizes access and opens up a broader audience. So I think we're always going to have some level of virtual work, virtual conferences, virtual among families. Education tech is huge. EDU tech is such a hot space right now for these reasons. The cost of college is exceptionally expensive. It is the one area over the past decade that has not seen any declines at all. And one way to help it make it be more affordable is through technology and through EDU tech. So I don't think that area is going anywhere. So longer term, that's what I like.
So one of the things that you said was SaaS, which is software as a service. So anything that is software as a service, kind of that work at home, kind of work from anywhere, that kind of technology. I do think that is the safest area of technology and very, very secure. As far as old economy things, I mean, it seems like the bigger the brand, the more stable they are. That's why I chose McDonald's. These brands, I mean, brand related, like even like Chipotle Mexican Grill. I mean, they did phenomenal in the, during the course of the pandemic. I mean, it seemed like Chipotle weathered the pandemic better than, most companies. And then a lot of the restaurant brands that we're very, very familiar with, the big restaurant chains, I mean, a lot of them are in real trouble. A lot of the big restaurant brands, like, I mean, I was just, like the Outback, like places like that, they didn't weather the pandemic quite as well. But certainly places that we should keep an eye on are, like you said, software as a service, the distance learning or at home learning. These kind of technology companies seem to have handled things very, very well. On that note, I'm going to jump to the charts. Jill, thank you so much. Your weekend is officially starting now. All right. And I will see you in 2 weeks. And we have yet another competition coming up. So, we'll be starting another competition soon, and enjoy the last couple of weeks of summer.
All right. You too, Mike. Take care, everyone.
Okay. Bye-bye. I'm going to jump and switch my screens here so that we can jump to the charts. And let me just transfer my screens. Let's just do this here. All right. So hopefully you can see my Dash Trader software. I'm going to just enlarge, my chart here of the S&P 500 ETF. That's the exchange traded fund for the S&P 500, which is the spiders. And if you notice, I mean, we just have had these kind of 1, 2, 3, 4 days, 1, 2, 3, 4 days, 1, 2, 3, 4 days. I mean, you have repeated 4-day pullbacks in a very, very big uptrend. I mean, this is not the worst kind of volatility that you can have. Each of these pullbacks have ended at the 50-period moving average, simple moving average. And of course, they've rallied quite considerably thereafter. So we've had, pullback, 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 4 pullbacks. And, this is on the daily chart. If you look at the weekly chart, you really have just been in a straight shot up. I mean, we've had an extended uptrend. The market is way up there at all-time highs on the S&P. If you look at the DIA, which represents the Dow 30, we've had a little bit of a more significant pullback than on the S&P. So you can see on the Dow, the pullback is a little bit deeper, but still ending at the 50-period moving average. On the QQQ, we've had a, pretty significant pullback, but the snap back on the NASDAQ has been more significant and more considerable. We are back near the highs on the NASDAQ, and that's that strength in technology. So certainly strength in technology. Now let's talk about my stock of the day here. We have McDonald's. If I look at the weekly chart of McDonald's, I mean, it certainly has paused a little bit and has come off its high at $245, high area. Now it's at $238. But, certainly in a strong uptrend. This is kind of a wedge formation or a triangle formation. And to me, that looks like it's probably going to break out to the upside. If you have any kind of increased volatility, probably a flight to safety would be in the direction of something like McDonald's. Let's just see. Let me just take a look at like some other stocks here. One notable stock of weakness has been like General Motors. General Motors is actually in a downtrend. Apple had an announcement earlier today that they're not sending their employees back to work until January in the office. So Apple still holding up and looking very strong. It's actually made like a consolidation breakout. And if I use my trend line tool to draw here on the chart, you'll see that we really kind of broke the upper trend line. So we've had an uptrend line break. And I'm just going to drag this to here. And drag this to here. So we basically had an ascending wedge on Apple, and we actually broke the trend line to the upside. Facebook had some news this week. They're being sued yet again, and some kind of new attorney general or is basically trying to press some new case. Doesn't ever seem to affect the stock. The stock continues to just go higher. Facebook had a pullback, but it's snapped back like many other tech companies. Let's take a look at, some infrastructure companies. I mean, tremendous run up on U.S. Steel, pulled back a couple of days, but I mean, U.S. Steel overall kind of hovering near its highs. I mean, that's a little bit disconcerting. Those topping tails, those topping wicks are a little bit disconcerting, but it could resume its trend. I mean, this is as old economy of a stock as you get. U.S. Steel, that's symbol X. Could be a consolidation. It's a little wide and whippy for a traditional consolidation, so you might be experiencing a little bit of distribution. Let's take a look at Caterpillar. I mean, Caterpillar is a stock that's showing real signs of weakness. So, Caterpillar, you have this is a big bullish week that got kind of negated by a big bearish week. And it's got a lot of clear air to the downside under the 50-period moving average. So on the daily chart, and that's a weekly chart. So on the daily chart, you could see that Caterpillar rose up nice and got completely rejected or sold into. I mean, that's the slowing of the global economy. There's a lot of reasons for Caterpillar to have some signs of weakness. So just be aware that there is some, real negative chart pattern starting to form up there. We have not seen negative chart patterns like this, which is a significant rejection from a high, possible head and shoulders, shoulder, head, and a weak right shoulder, which could lead to a breakdown. I mean, this is significant weakness. DE, John Deere, which is farming equipment, also has a similar pattern. So we're starting to see, and I mean, if you look at the Dow Jones has a bearish cloud cover. So you have a green bar that's negated by a red bar. So there's a lot of signs that we're ready for some kind of correction in the Dow. I mean, the technology still seems relatively stronger than the old economy stocks, but that could change with inflation fairly quickly. All right, so on that note, let's take a look at our last two stocks, GBTC. This is a tremendous run has been occurring on Bitcoin from 25 on the GBTC all the way up to 39. So really strong run back up. I mean, very possible for this to run all the way back up to 50 or even 55. That would be a breakout area above 58. So GBTC, which is the grayscale Bitcoin tracking stock, is making a run to the upside. ETHE, Ethereum. I'm going to zoom in here because you could see that Ethereum has also been making a run. Ethereum is up to it's at 30 on the ETHE, which is the grayscale tracking stock for Ethereum, and that is potentially going to break out above 33.75. And if it does, I mean, that's breaking out for a possible run to the 5,000 on Ethereum or 50 on the ETHE, which would be a new high on Ethereum. So cryptocurrency with the weakening dollar has certainly done very, very well. GLD, gold. Gold not really running, but also not doing badly. Let's zoom out on gold. So gold, GLD, it's kind of just hanging in here. I mean, it did make a huge run, previously. It's kind of pulled back and settled in at 166. So gold possibly putting in a higher low. Gold does usually run into February of next year, February 2022. From this point, it starts to bottom out and then run. So possibly this might be a bottom on gold. SBL, let's see. Silver, usually it's weaker than gold it's either stronger in bullish times, weaker in bearish times. So silver looking a little bit weak relative to gold. Last but not least, we're going to take a look at USO, which is oil. And oil really looking a lot like Caterpillar and John Deere, with the global economy potentially slowing again. China had a slowing economy. So certainly that's not good it's usually used as a kind of gauge for the overall global economy. So certainly a little disconcerting that the global economy is slowing down again, possibly for the Delta variant, possibly for 100 other reasons, but certainly, it certainly looks like it's slowing and it's affected the price of oil. So on that note, we're going to jump back to the charts. Back to the slides rather. And we are getting ready for yet another competition starting in a couple of weeks. So stay tuned for that. Today, we are releasing our 7th most recent part of our 8-part series on styles of trading. So certainly check out our YouTube channel. So visit our Dash Trader Pro YouTube channel to view it. Stay up to date with all things Dash Trader by signing up for our monthly newsletters. Simply fill out the form at the bottom of our website, www.dashtrader.com. Subscribe to our YouTube channel, Dash Trader TV, for Dash Trader Newsroom reminders. Follow us on social media, on LinkedIn, Twitter, Facebook, and Instagram. Everybody have a wonderful, wonderful weekend. Enjoy the rest of your summer, and look forward to seeing you all in 2 weeks. Bye-bye, everybody, and thank you so much for joining us today.